The stock market can seem thrilling at first, but the moment people start using terms like P/E ratio, dividends, or Fibonacci retracement, it suddenly feels confusing. Don't worry, you're not the only one who feels that way.
In this video, we're going to make things easy. I'll explain all the key stock market terms in simple, everyday language so you can finally invest with confidence.
A stock or share is simply a small piece of ownership in a company. When you buy a stock, you actually own a part of that company.
For example, if you own one share of Apple, you're a small owner of Apple. The word equity also means ownership. It shows how much of a company you own and how much profit or assets you have a right to.
A stock exchange is like a marketplace where people buy and sell shares. Imagine it as an online store, but instead of clothes or gadgets,
People are trading companies. The best-known ones are the New York Stock Exchange and NASDAQ. A ticker symbol is just a short code for a company's name on the stock exchange, such as AAPL for Apple, TSLA for Tesla, or JUGL for Google. Your portfolio is the total collection of your investments. For example, if you have shares of Apple, Microsoft, and some index funds, all of these together make up your portfolio. An investor is anyone who puts money into something, like stocks, real estate, or businesses, hoping it will grow over time. A broker or brokerage is a service that helps you buy and sell stocks. These days, online brokers like Robinhood, EXTrade, and Fidelity make trading simple. A commission is the small fee they used to charge for trades, though most online brokers now offer zero commission trading. A public company sells its shares to the general public through the stock market. These companies, like Apple, Amazon, or Coca-Cola, must share their financial information openly. In contrast, a private company is not listed on any exchange and is usually owned by a small group of people or investors,
such as SpaceX or IKEA. A dividend is a portion of a company's profit given to shareholders.
Many stable companies, like Coca-Cola, pay dividends every few months. If you sell a stock for less than what you paid, that's a capital loss. Yield is the return you earn from an investment, usually shown as a percentage. For instance, a $100 stock paying $5 yearly has a 5% yield. ROI, return on investment, tells you how much profit you made compared to what you invested. Compound interest is the magic of earning interest on top of your previous earnings. It's one of the main ways wealth grows over time. Your risk tolerance simply means how much market fluctuation you can handle emotionally and financially. Some people can stay calm during big ups and downs, while others prefer steady, safe returns. A market order buys or sells a stock right away at the best available price. A limit order only works when the stock reaches a specific price you've set. A stop-loss order automatically sells your stock if its price falls to a certain level to protect you from heavy losses. A trailing stop adjusts itself automatically when prices rise, locking in profits. A fill or kill order must be completed instantly or canceled, and a good till canceled order remains active until you manually cancel it. A day order ends automatically if it's not completed by the end of the trading day. When you short a stock, you're basically betting that its price will drop. You sell borrowed shares when the price is high, hoping to buy them back cheaper later. Closing this position is called buying to cover. But short selling is risky. If prices go up instead of down, losses can be unlimited. Common stock gives you both ownership and voting rights, while preferred stock usually gives fixed dividends but no voting rights. Blue chip stocks belong to big, trustworthy companies like Apple or Coca-Cola. Growth stocks are focused on fast expansion and often reinvest their profits. Value stocks are those that seem underpriced compared to their real worth. Dividend stocks pay regular income, while cyclical stocks rise and fall with the economy. Defensive stocks stay stable even in hard times, and penny stocks, priced under $5, carry high risk but also high reward. A bull market means stock prices are rising and investors feel positive. A bear market means prices are falling and people are afraid to invest. A correction is when the market drops around 10% or more to balance things out. while a crash is a much sharper and faster drop. Volatility tells how much prices move up and down, and liquidity means how easily something can be bought or sold. Volume shows how many shares are being traded.
Market cap measures a company's size by multiplying its share price by the number of shares.
Earnings per share tells how much profit a company earns per share. The P/E ratio compares stock price to earnings, while the P/E-G ratio also includes growth in the calculation. Book value is the company's net worth after debts. Intrinsic value estimates what a stock is truly worth based on fundamentals. Dividend yield shows how much dividend you get compared to the stock price. And beta shows how volatile a stock is compared to the overall market. Revenue is how much money a company earns from sales, while net income is what's left after paying all expenses. Operating margin measures how much profit comes from core business operations. And profit margin shows the percentage of total revenue that becomes profit. The debt-to-equity ratio shows how much a company depends on borrowed money. And return on equity reveals how effectively it uses shareholder funds to make profits.
ETFs, or exchange-traded funds, are collections of stocks or bonds that trade like one stock, giving you diversification at low cost.
Mutual funds also combine investors' money and are managed by professionals, but trade only once per day. Index funds simply follow the performance of an index, like the S&P 500, instead of trying to beat it.
Real estate investment trusts let you invest in property projects without buying actual land or buildings. Hedge funds are private investment funds that often take big risks to earn high returns, mostly for wealthy investors.
Options and futures are financial contracts that allow you to speculate on or protect against price changes. Bonds are loans you give to companies or governments, and they pay you back with interest over time.
Major market indexes include the S&P 500, tracking 500 big U.S. companies, and the Dow Jones Industrial Average, made up of 30 blue-chip firms.
The NASDAQ Composite focused on technology companies, the Russell 2000, which tracks small-cap firms, and the VIX, known as the Volatility Index.
It's called the Fear Index because it reflects how much volatility or uncertainty investors expect in the market.
There are different ways people trade. Day traders buy and sell within the same day, while swing traders hold stocks for a few days or weeks.
Position traders hold for months, and long-term investors keep their investments for years, like Warren Buffett. Value investors look for cheap but strong companies. Growth investors go for fast-growing ones. Dividend investors prefer regular payouts. Index investors follow the overall market. Contrarian investors go against trends. And momentum traders chase strong upward price moves.
Emotions also control much of the market. FOMO, or fear of missing out, can push people to buy at the wrong time.
A pump and dump is a scam where people raise a stock's price by hype and then sell at the top, leaving others with losses. Overbought means a stock has gone up too fast, and oversold means it's fallen too much. A bubble happens when prices rise far above real value and eventually crash. A correction is a smaller fall that helps prices return to normal. Investors usually rely on two analysis styles: technical analysis, which studies charts and patterns, and fundamental analysis, which focuses on a company's financial health. Technical tools like moving averages, MACD, RSI, and Fibonacci retracement help traders spot trends, momentum, and turning points. Candlestick charts, breakouts, support, and resistance are common concepts in trading. A margin account lets you borrow money to buy more stocks. This is called leverage, and it increases both gains and losses. Alpha measures how much better or worse your investment performs compared to the market, while the Sharpe ratio compares returns to the level of risk you took. And one last golden rule: diversification. It means not putting all your money in one place. By spreading your investments across different assets, you lower your risk. So if one stock falls, others can help balance the loss. Now that you understand the main language of the stock market, you're already one step closer to being a smart and confident investor. If you found this helpful, remember to like the video, subscribe for more simple finance content, and share which term you'd like me to explain next.